Right now, there are 3 companies that look undervalued. It feels like the market has made a mistake. Now, guys, investing is an art. It is not a science. What that means is we don't know the future, so we have to make assumptions about what will happen. Could these 3 companies be the most undervalued in the market right now? Absolutely. Could they be overvalued? Of course they could. Could they be at fair value? Absolutely. The goal of our channel and why I created this channel was to show people that our job as investors is to teach a process that involves making assumptions about the future. And these 3 companies are selling at prices that could very well be interesting. Let's break it down. Now, all of these stocks are in the retail sector, which is a tough market, but we're here to break them down. The first one, Lululemon. Guys, this one is extremely interesting. Now, I'm not one of those guys who says it's extremely interesting just as an excuse to talk about it. This is a $20 billion company. This is a company that generated $1.17 billion in free cash flow. This is a company that anybody out there who has a wife, girlfriend, sister, mother, they probably love Lululemon. And as an investor, all-time high, 516, down to 165 to 170. Guys, we have 90 people in our community who have this rated as a buy. Only 3.3% have it as a sell. My concern about this, and for those of you who are new to investing at the channel, this might seem overwhelming, but I'm going to try to break this down as simply as possible. This is retail. And a lot of people have a lot of issues with retail. Guys, we are still going to buy lots of stuff. Lululemon is a premium brand. It's not like the high-end brands like Hermes and Gucci and all that stuff, but it is a premium brand where you have to spend good money to enjoy the products. But again, women love it, and they've even catered to men as of late. Some other things on here. They did $11 billion in revenue last year. One thing I don't like is their net income is $1.8 billion. Their free cash flow is $1.17. This is a big disconnect. It's easier to manipulate this number than it is this number. Free cash flow is much harder to manipulate. So we like it when it's a company like Adobe that has significantly more free cash flow than net income. Heck, we even want it to be within 10 or 20%. This is quite the disconnect. And there could be a very logical reason for it. The reason could be building out new stores, gets rid of the cash flow, but doesn't get rid of the net income. So you have to dig a little bit deeper, and those in our community, hopefully you guys are having this conversation. No dividend, luckily, it's a growing brand. Profit margin, the last 5 years was 15%, last year 16.4%. Is this a trend that's going up, or was it a fluke last year? Guys, gross profit, 60%. That's what NVIDIA was before their recent surge. That means every extra unit they sell, 60% of it goes to that bottom line before taxes and overhead. That's an incredible, incredible number. And guys, very little acquisition, $600 million in the last 5 years. But look at this revenue growth. 15.5% a year for the last 3, 23% a year for the last 5, 19% for the last 10 years. That's incredible. The question is Lululemon here to stay? Now, guys, I went through some key metrics here. There's a lot over here. And again, if you're new to the channel, even if you're not new to investing, but you want to have the breakdown of all these metrics, I've got an absolutely free PDF. Click the link below. We will email you the PDF within a minute. Absolutely free. It'll go through every single one of these metrics and explain it to you about why it's there, what it means, and why it's important. So please do that so you can watch our videos speaking the same language. We all have the same foundation. Because no matter what your opinion is on any company we talk about, what these are all factual. It is what it is. Free cash flow is only calculated one way. Let's understand that and let's be on the same page there. In a couple minutes, I'm going to show you guys what price I think the stock should be at. But I want you guys to remember that I'm teaching this on YouTube as a way of explaining my world of how I view money. Now, it doesn't mean you're going to agree with me, and you shouldn't agree with me on everything, but there should be things you take from it saying, oh, okay, that makes sense. I look at stocks as buying a piece of a business, and I want you to as well. Let's go to analyst estimates here. So it's retail, but look at analysts. $14.60 per share last year, growing to $23.83 in the next 4 or 5 years. That's some big growth here, some big jumps along the way. Now remember, if we are in a recession, luxury goods like this, which are kind of upper middle class, lower upper class luxury item, will probably suffer a little bit. That's okay. You have to be ready to buy at the right price. And this is the revenue growth for the next 10 years. Not big. 6%, 7%, 5.5%, 11, 7%. Not huge growth levels there. But now we have to sit there and we have to remind everybody what we're doing here. I don't want you to just focus on the story. It's the story and the numbers put together. That's the important part. And that is why we have our stock analyzer tool. And Lululemon should be there to sit there and understand when you put the story and the numbers together what it means. Remember, a stock that goes from mid 500s down to 160 should automatically grab your attention. Doesn't mean it's something to buy, but should automatically grab your attention to look further into. And nobody can deny that Lululemon is an up-and-coming brand. The question is, do they have staying power? Now, I'm going to be conservative in my assumptions about Lululemon. You might be looking at my assumptions and say, this guy isn't being conservative at all. He's being too aggressive. I've made different assumptions last week and talked to our in-house people, and I kind of agree with them more. Guys, I did 2%, 4%, and 6% revenue growth in the next 10 years. That's pretty low. Now, the reason I'm doing this for me is, and the reason you shouldn't do it for you is, Lululemon is not part of my 33 stocks I want to own forever. This could be a special situation that I think is mispriced, which is a company I don't want to own for a long time. So I got to make a lot of money off it for me to justify buying it, which means I got to make more conservative assumptions. I have my list of 33 companies I want. I own a chunk of them. But if I want to own those ones forever, anything I add to it better be a huge screaming deal. That might not be the same for you because you might understand Lulu far better than I do. Profit margin and free cash flow. I did 13 to 16%. 13, 14, 15, 16, somewhere along that range. Now, what is the PE and price of free cash flow 10 years from now? Guys, I did 12, 14, and 16. Now, I want you guys to notice something. Their return on capital is that first line here. It's actually been increasing over the last 10 years. This deserves a premium. But I also think, but it's also retail, and you'll see in some other companies I'm going to show you next that that's not really the retail I'm dying to own, so I'm still going to give it a discount for myself. But if you told me, Paul, I want to put a premium in this company, I would get it. I would understand that. I don't look at it going, you're stupid. I just look at it and say, yeah, but for me, I'm being more conservative, and my desired return is 9%. This is not my real return. I want to figure out what's my value for the company on the market. 9 or 10% is there. But I need to have margin of safety because the future's unknown and we're humans and we make mistakes. So when you do this in the stock analyzer tool, as you control it, put a much higher number than 9%. How much higher? Everybody has their own level. But the stock's currently at 167 on the nose. I hit the analyze button. Guys, I have a low price of 150 to 160, high price of 270 to 290, middle price of 200 to 220. Now, keep in mind, guys, that 2-3 years ago, when it was $500 and some dollars, people would have said, you're crazy. Now look where we are. This happens. Look at Nike. It was at $180 a share, got down to 50 or 60 bucks a share. At 180, people thought we were crazy saying we'd only start looking at it below 100. So these are the things I want you to remember. But even here, at the middle assumption, 11.9%, yeah, I was being conservative up there, but I don't think it's there for me yet. But if this thing keeps going down, I'm going to start paying attention very, very soon. How soon? Guys, maybe I want 15% returns, which means I got to wait until this stock is below 130. So you know what I'm going to do? I'm going to add it to my watch list at $130 per share. That gives me over a 15% return on my money, and that's when I'm going to start paying attention. Now, guys, keep in mind, this could be a temporary mispricing. They fell drastically in the last few months, most recently last week, because they missed slightly on revenue, beat on earnings, but they guided much lower for the future. Could it be a sign of recession? An upper middle class kind of luxury good all of a sudden missing on revenue or about ready to guide lower? Is the economy getting softer than we think? I don't know. Stock number 2, Louis Vuitton. Guys, I want you to watch the screen right now. Look at all the brands that Louis Vuitton owns. It isn't just Louis. It is a ton of other brands across a plethora of areas. Now, Louis is a high-quality brand, and they want to own other high-quality brands. This is a company that is a $300 billion company, $290 billion. Gross profit of 67%, which is very high. But again, you know what I love about them? The brand itself, Louis, they don't give discounts. Oh, you don't want to buy this? Great, we'll just destroy it. I actually love that. That enables them to say, listen, if you're not willing to pay, we'd rather destroy it than cheapen the brand by giving discounts. That's absolutely brilliant. Now, guys, they've made acquisitions, $18.5 billion in the last 5 years. In the last 5 years, they've done 9.5% revenue growth, 9.5% in the last 3 years, almost 11% in the last 10 years. Now, there's a lot of theories out there. People will say, companies like this, they don't really suffer during recessions, etc. Maybe. It could be the case. Now, one thing I want to go before I show you that is they pay a dividend of 3%, which eats up $8.5 billion of their cash flow, but they generate $15.7 billion in free cash flow last year, $14.2 over the last 5 years. And guys, remember what I said before about Lulu? They have a higher free cash flow than net income here. What I'm surprised about is their return on capital is not very high. It's higher than when we want. 9 or 10% is the market average. It is 11 of the last year and 12% of the last 5 years. But you saw Lulu. It was starting to break almost 30% there. That's a big difference. This company is an 8-pillar thriller. It's got all 8 check marks. Doesn't mean you buy it, but it tells you a story. Guys, this story here is lower debt, reasonable free cash flow, multiple $6 billion growth in free cash flow, net income growing 6.3. There's a lot of stuff here that I really, really like a lot. Foreign companies don't buy back a lot of shares, but the CEO has been buying up shares of the company as of late. They only buy shares of their companies when they want to make money. That could be a good indication. Who knows if he's right or wrong, but I do think if you talk to me 20, 30 years down the road, I'm willing to bet you Louis Vuitton is still around, still dominant. It has much higher revenue and profit, and that's what we really want to look at. But we got to put this all together to make sure we're not overpaying for a great story. Because if you overpay for a great story, guess what happens? You get a bad investment. You've got to remember that. Let's go to our stock analyzer tool, and let's pull up some assumptions here. When was the last time I did Louis? Well, right here. So I did a 10-year analysis. I did 4, 7, and 10% revenue growth. That's basically doubling every 10 years. So it's going to double their revenue 10 years from now. Profit margin, 13.5, 14.5, 15.5, but free cash flow I did 15, 16, and 17. Keep in mind, the middle number of 16, lower than their 5-year number. The middle number up here of 14.5, lower than their 5-year number. Kind of interesting, right? Now, what is the PE and price of free cash flow you'd put 10 years from now on a brand like this? Guys, I put 20, 23, and 26 because it's a premium brand. It's been around for a long time. It's probably not going anywhere, and it's synonymous with luxury. You've got to remember that. And again, my 9% desired return. Now, the story here has been great, and we all love a great story. And believe it or not, 25, 30 years ago, I was only chasing the story. I was chasing hot stocks, tips, getting caught up in the hype, hoping that something would stick. But guys, if you're only going to buy any of these names because of the story, that isn't investing. That's gambling. That's hope and prayers. That's exactly why I created Everything Money. I realized what I needed 25 or 30 years ago that I didn't have. I created it here. All these tools, all the software here was something I was using for myself. All we did was add the community and allowed people to access this, and it's an absolute game changer. If you choose to join Everything Money, you're not just getting our powerful investment software, and obviously our stock analyzer tool, which has become, I go on Twitter and see screenshots of our stock analyzer. You're getting that foundation. We want to integrate you into this community. We offer you courses that are absolutely free so that we all have that same foundation and get you engaged into our community of like-minded investors who all have one goal: to level up their investing so you have the right mindset to make more money. The tools will help. The software will help. Everything here will help you make more money. And guys, we're actually about ready to add a brokerage platform that allow you to connect your Robinhood, Charles Schwab, Fidelity, Webull, all of these brokerages into our platform so you don't have to sit there and go back and forth. You can literally buy and sell stocks from our software. That is coming very, very soon. It's going to make it even easier for you to go to one place to have everything. But I want to be clear. This isn't for people that want to chase some next shiny object. If you aren't ready to learn and follow a process and stick with it, a process that you're going to modify to fit your personality, don't sign up. If you're committed to investing the right way and putting in the work, I guarantee you it'll be fun. You'll feel a lot more reward out of it. And you just got to do it by starting your 7-day trial right now. So click the link below. We have limited spots each day. So if you're serious, sign up and I will see you in the community. Now, back to this stock analyzer. I hit the analyze button. The stock's currently at 584. It's kind of interesting. Everything is green except for one. We have a low price of 587, high price of 1282, middle price of 870. That means a middle return. If my middle assumptions occur, I'm looking at a potential 14.5% return, not including the dividend, I mean. The dividend's in there, so don't go adding the dividend of 2.5% or whatever it is into that. Guys, that's incredible, and Louis is on my list of 33 stocks to own. You got to take it seriously if you're interested in that. It is retail, but if you've ever been to a Louis store, it does not operate the same way as other retail. Which takes us to our third company, a company that I've been buying ever since 130, all the way down now to $91 per share, and that's Target. Target has been hit as of late. It is a $42 billion company, all-time high of $240 per share. It's now at 91, guys. $91 a share. Monster dividend. 5% dividend eats up $2 billion of their $3 billion in cash flow, so they can still afford it. But guys, they're selling for a 10 PE and a 14 price to free cash flow. They get high returns on capital. 5-year average is 14.5%. We have almost 30 community members who have this rated as a buy. Guys, I heard from my sister-in-law once that she loves how Target makes it easy to order from them, pick up, and return items. That's what matters. Yes, they got hit with retail. Yes, they got hit with theft, but they're working to change that. I look at this world and say, what are the chances that Target does not exist in this world 20 years from now? And if they are going to exist, are they likely to have more revenue and profit than today? If the answer to both those questions is yes, all we have to do is find the right price. Let's go see what the analysts believe. Well, guys, they're not seeing much growth in earnings per share. In fact, they're seeing a dip. But 5 years from now, they're seeing $8.79 growing to $10.40. Not a lot. And guys, it's pretty consistent what they're saying here on revenue. $107 going to $117. That's not a lot of growth. But remember, guys, I want to give everybody an example. When I hear people say that's not growing, let me ask you a question. If I were to sell you a business today, that year one was going to make $5, then $4, then $3, then $2, then $1, then go to $0. How much would you pay for this? This is a declining business. Declining. Would you pay $1 for it? Well, guys, you're going to collect $15 here over the next 5 years. Of course you pay $1. You get your $1 back plus $14. Would you pay $20 for it? No, of course not. Why would you pay $20 to get 15 and then no business? Would you pay $5 for it? Yeah, you're going to take 5, make it 15. Somewhere between 5 and 20 is the right number. My point about this is to say, guys, just because something doesn't have a lot of growth potential doesn't mean you should still ignore it. If there's a price cheap enough that still makes it a good investment, you've got to consider it. If you don't feel comfortable with that, do not go any further. You have 10,000 stocks out there to choose from. Don't try to force one. But with that in mind, what is the right price to pay for Target? Well, they're factoring in 3.5% growth in revenue. That's what I did here. 10-year assumption, 3.5%, 5%. If we have a lot of inflation, if they kill it, if things turn around, maybe they can get 5%. Maybe they suck, it sucks, 2%. Profit margin, I did 3, 4, and 5. Same with free cash flow. PE, I did 15, 18, and 21. Let's go lower. Let's go 12, 15, 18. Because they're able to rebound, that's great. Hit the analyze button. I have a low price of 90, which is basically where it's at. I have a high price of 230. I have a middle price of 150 with a 16% return in the middle. Am I right here? I don't know. But if I'm able to find 30 stocks that match this criteria, I will probably do very well. And just to show you that, earlier this year, I did pick 7 stocks to go head to head with the real Magnificent 7. I'm calling them my own Magnificent 7. And guess what? They're winning. And I'm not just talking about theory. I put these picks to the test. These are stocks that I have in my portfolio, and they've been outperforming the market's biggest names. So click on the video on your screen to see which 7 stocks I picked that are beating the real Magnificent 7 and why I think they could keep winning for years to come. Thank you for your time.